What up? What up? What up? What up? Welcome to another installment of Run Up the Millions. I am your host, Mark Chill, and appreciate y'all rocking with me. A little bit about myself, like I've been saying before, licensed mortgage banker, been doing this for 12 years, licensed in 21 states, federally and state licensed. So, wealth of knowledge when it comes down to it. If you've been rocking with me for the last couple of weeks, we done went over credit. For the first couple of weeks, we talked about last week. We talked about conventional loans versus I'm sorry, not conventional loans. The pros and cons of owning versus renting, and so kind of recapping that. Obviously you get the aspect of owning the house. It's your shit. You get to build equity, and you kind of do whatever you want to do in it. Downside, obviously, is that because it is yours. In most cases, you are responsible for the maintenance. You got to pay the insurance. You pay taxes. Things of that sort. So obviously, pros and cons. If you missed that, check that out. That's from last week. Got to give a shout out to my boys over at Fly Exports. If you're looking for some dope merch, some dope clothing, you can check out the little. Use the code Martin. That'll give you 10% off your order, and this takes you directly to the website itself. So you're looking for something right there. Bam, they got you. And then I got these black eye shirts. If you want something like that, just DM me. And these are only like $10. Nothing crazy. And I'll get one of these to you. Today we're gonna be talking about FHA loans. We're gonna dive right into it. FHA loans are they're the oldest type of loan because they came out like right after the Great Depression. They were created so that the economy can kind of stabilize when it comes to home ownership and getting the economy back on its feet after the Great Depression. So it's the oldest type of loan that's available, and is honestly like one of the easiest loans to qualify for, other than VA loans. And obviously with VA, you got to be a veteran. But when it comes to an FHA loan is a government backed loan, right? And the whole point of that is so that it has a low down payment requirement. It is backed by the FHA, which is the Federal Housing Authority. And generally it has a lower credit requirement as well when it comes to qualifying, your debt ratio, all of that. So it's a lot easier to get qualified for for an FHA loan than it is pretty much any other type of loan. So like I was mentioning, when it comes to the actual FHA, this is what it is right here. Bam, you can see that it's a home mortgage that's insured by the government. It's issued by a bank or another lender, basically like Chase. They'll issue the loan, but the FHA actually they backs it. FHA is not it's not a bank, it's not a lender in itself. It's just a government entity, kind of like Fannie Mae and Freddie Mac, they're government entities. So you can't call it FHA, right? It doesn't work like that. You get a house, you get your loan, FHA backs it, you make your payment to whoever your creditor is, basically Chase, Wells Fargo, Rocket, Better, so on and so forth. Right. So that is the aspect of FHA loan as far as the actual true definition. All right. Now, going back to not that. Now, going back to some of the guidelines when it comes to FHA, I mentioned that you have like a low down payment, low credit score. This is kind of like the dope part of when it comes to FHAs, because like your minimum credit score on an FHA loan is only 580, right? Now, 99% of the time is 580. Okay. There are some lenders who will allow you to have as low as a 500 credit score and be able to buy or refinance your home with that lower credit score. The caveat is that there are going to be some other qualifying criteria. So before we actually get to that, I want to explain the whole aspect of qualifying criteria and some lenders. So the FHA has their own guidelines. Okay, this is actually it right here. Bam. Right. You got the minimum down payment is only 3.5%. Right. If you have a credit score of at least 580. Right. If you have a credit score of less than 580, let's say 579 or 500, then your down payment requirement is going to be at least 10%. Okay. So, but the caveat to that is that a lot of lenders, they have overlays. So the FHA, they have their guidelines. Hey, as long as your credit score is above 500, we're cool. Bring down payment at 10%, yada, yada, yada. But because lenders are the ones that are actually hedging the money, they have what's called overlays. And these overlays are like rules on top, are basically just rules on top of the rules. Okay. So if you go to Rocket and you're like, hey man, my credit score is at 550, Rocket's more than likely going to tell you to kick rocks or come back when your credit score is higher, because they're not going to risk you borrowing however much money when your credit's not, in a position that they feel like you're going to be able to pay it back, if that makes sense. So in most cases, your minimum credit score is going to be 580. And with that 580, even though you're 580, like you're still going to have compensating factors. You might have to have a certain amount of reserves or assets in the bank. You might have to have a lower debt ratio, right? Which is basically the difference between what you owe that's on your credit report monthly, your monthly payments on your bills that's on your credit report, excluding um, excluding utility bills, excluding medical bills, um, whatever your payments are on your credit report, use that versus your income, and that's your debt ratio. Generally, your debt ratio has to be at least below 43% when it comes to an FHA loan. If it's and that's where the compensating factor comes in. If you have a credit score of 580 or less than 620, then you may have to have a lower debt ratio, higher reserves, so on and so forth, to be able to qualify for that loan. Right? It just all depends on the lender that you decide to go to. But this is kind of some of the details in itself when it comes to um, the FHA criteria. Right. Now, also when it comes to FHA, last week we talked about condos, right, versus single family residences. And you can get an FHA loan with a condo, or so you can get a condo on an FHA loan, but it has to qualify. And what that means is that every condo has to be, there's an approved list that FHA sends out. And depending on the condo complex that you want to buy or looking into, they're either going to be approved or not approved. If they're on this list, right here, and this is all on, you can see it right here. It's on HUD.gov. This is their website. All you do is you type in the name, the name or the city or the zip code. So, give you an example. I'm in Atlanta. What is it? 30303 out here, something like that. You hit send. It's going to pull up all the list of all the condos that are in this zip code, right? If it's approved, like this one, it was approved, but it expired back in September, right? So if you were to try to live at, what is it, 123 Lucky Street in Atlanta, and you try to get an FHA loan on this property, you're going to be denied, right? It's not going to go through because it's no longer approved. And now this entity, this place will have to go back, reapply to be put back onto this list. And sometimes they get rejected, like this one, rejected. This one expired, rejected. This one, the Healy, this one has been approved, right? And it don't expire until 2027. So this website will tell you, if you're looking at a condo, if this is something that's easier for you to qualify for, or you don't want to have the maintenance of a house, you know what I'm saying? You want to be able to just do your thing. This website will tell you what's approved, what's not approved. And if it's not on this list, it ain't approved, right? So, or they never applied, they never even tried to get it approved. So that's kind of a dope thing when it comes to FHA too, is that they're giving you the information that's needed to be able to make sure that your loan can go through. You just have to do the due diligence of checking your T's and your I's, so that you're not wasting your time or even your lender's time, because now you're talking about money being spent, potential, appraisals being done, potential, what's the thing called, inspections being done, all of that. So you want to make sure you're doing your due diligence when it comes to qualifying and the home that you are actually looking for. So the minimum down payment on a house is at least 3.5%, which is dope. And even though you have that low down payment amount, then you still will have closing costs, right? And so with that, an example of a loan with closing costs or fees that you might have to pull out of your pocket. Here's a dope actual uh, kind of visual when it comes to what you may or may not be expecting when it comes to your down payment and the down payment process. So we got FHA loan. Your payment prices or your purchase price is $250, right? $250,000 at 3.5%. You're talking about 8750 of a down payment. So that is cash out of your pocket up front. And then obviously when it comes to closing costs, the closing costs are going to be whatever the costs are based off of whatever rate you choose. So, and we'll get into interest rates next week as far as how that whole aspect works. But think of closing costs like the cost to close a loan. Obviously, your taxes and insurance, origination, third party costs, appraisal, so on and so forth. All of that is your closing costs. So you bring your down payment plus your closing costs to the closing table in the form of a cashier's check, and then once that clears, you have the turnaround time as far as when you can actually get your keys, and then you're done, right? One of the catches when it comes to FHA, and a lot of people don't like this, is that FHA has this thing called private mortgage insurance. And what private mortgage insurance is, it's insurance again, it's insurance for the lender, basically. Basically, what that insurance does is it protects the lender in case you default or foreclose on the house. So this is not something that if you pay it, because you're going to be required to pay it no matter what. It's not something that you pay it and then if something happens, like you die or some shit like that, then the house is paid off, which is a common thing that people think that this is. Like, I have this mortgage insurance, and that means that if something were to happen to me, then my house is covered. No, that's not mortgage insurance. That is a life insurance policy that you want. You know what I'm saying? So mortgage insurance protects the lender in case you default or foreclose on the house. Because the qualifying criteria is so lenient, it is easy for people to default or foreclose on the house, especially when you have to factor in the payment, the mortgage insurance, your property insurance, your property taxes, all of that. And then life happens, right? Which is kind of like 2008 and 2009, and hell, even inflation now, where it's difficult for people to be able to make the payments. So this insurance covers the lender in case you default. They pretty much are covered on the loan, right? They're paid in full when it comes to the mortgage insurance. And because you put down less than 10%, any FHA loan where you put down less than 10%, you are required to hold on to that or to pay that mortgage insurance for the life of that loan or until you refinance out of it. All right. So that's kind of the dope thing about owning a home, is that you can always refinance your loan to a better or more favorable term for you, whether you want to pay it off faster, whether you want to try to lower the monthly payment. You can pay the balance down a lot. So now you can actually restructure the loan in the form of a refinance or a lower interest rate, and have that lower monthly payment for you. So you're going to carry that mortgage insurance in either for the life of the loan if you put down 10% or less than 10%, or if you put down more than 10%, you're going to carry it for 11 and a half years. That's the guideline on FHA mortgage insurance. And again, that's until you refinance out of an FHA loan into a conventional or VA loan. You have to get out of FHA entirely to not have to pay that PMI. And that mortgage insurance, the amount that you're paying on that PMI is really contingent upon the balance of your mortgage. So when you close, you're going to pay what's called an upfront mortgage insurance premium, and that amount is 1.75% of the loan amount. So if you have $100,000 home loan, right, and you have to pay this into your closing costs. This is a part of your closing costs. So you have $100,000 home loan, and now you're closing your mortgage. You have your closing costs plus the 1.75%. So that's basically just under $3,100 in extra costs that you're paying to be able to obtain this loan, right? And then the actual percentage or the monthly payment of the PMI is at 8%. And that's this here. That's this here. So you're going to pay the 1.75% upfront. That's built into your closing costs. That's built into your closing costs or built into your home loan. When you buy the house, it's going to be built into your closing costs. So that number I gave you earlier, that eight grand or so, that's really going to be closer to 11 because you have your closing costs plus your mortgage insurance, your escrows, things of that sort, all built into, and you have to bring that check to the closing table. Right? So that's really just how that works. That's how the payment is calculated for you. Like I mentioned, you have the mortgage insurance either for the life of the loan. If you put down the 11% or more than 10%, then it can be removed after 11 years. And again, you can always refinance out of this type of loan into a conventional mortgage as long as you qualify for the conventional mortgage. I got to make sure I put that disclaimer in there. But there are some other cool things about an FHA loan. An FHA loan has this thing called a streamline. So what a streamline is if you wanted to refinance your house. Let's say you bought your house, the interest rate's at like 7%. And since you bought your house at 7%, the rates have come down. So you could do what's called a streamline, which is where there's generally no appraisal that's required. There's generally no closing costs in most cases, depending on what rate you choose. Um, in most cases, all you do is you bring a payment to the closing table. So let's say you close at the end of November. You're going to bring your December's payment to the closing table. That's your closing costs. And then your first payment won't be due again until January, which is going to be at the lower amount, whatever that payment may be. So you get a lower interest rate, you restructure your mortgage, lower monthly payment, no closing costs, there's no appraisal, and the process is relatively quickly. The closing time is relatively quick because they already know they already know your FHA stuff, and it's just FHA to FHA. So all you're just doing is that's why it's called a streamline. They already have all the paperwork, they already have the documentation on your current loan. So they're just restructuring, reformatting. That does restart the clock on your PMI though. So if you go back into an FHA loan and you have less than 10%, then you're still going to have that PMI for the life of the loan. Or if you have more than 10%, you're going to restart the clock on that 11-year time frame because it's a brand new loan. So whenever you restart or whenever you do an FHA loan, that clock starts all over again. Okay. So if your goal is to get out of having, the mortgage insurance on that note, then ideally you want to go ahead and try to have as much of has as much equity as possible. And with the way that the economy is working right now, hell, you could probably have the equity that you need to get out of having that mortgage insurance just because the values are increasing, so substantially on houses right now. It's really crazy. But it's also good because if you decide that you want to sell after 2 or 3 years, then you have the luxury of doing so and you're actually going to make money off of it. Now, with that being the case, an FHA loan is only allowed on primary residences. You cannot do a You can't do an investment property. You can't do a second home when it comes to purchasing on an FHA loan. It's only for primary residences. And with that 3.5% is really a kind of a flex, or it's a hack. It's a hack because that 3.5%, you can buy yourself a duplex, a triplex, or a fourplex. And as long as you're living in one of those units, it would still count as a primary residence. And the biggest hack when it comes down to that is if you buy a fourplex, let's say you buy a fourplex, you can use the income from the other three units to help qualify. You know what I'm saying? So you get the leniency of the low down payment, the 3.5%. You get the leniency on the debt ratio. You get to use income that ain't even really there yet because it's income that's going to be received because you're going to rent those three units out um, to help you qualify for the loan, and you actually get to live in the house itself. You know what I'm saying? So that's probably the biggest hack when it comes to FHA, because on conventional loans, in order to do like a two to four unit property, the down payment is actually a lot larger. It's anywhere from 5 to 15% on a conventional loan. So again, super lenient when it comes to being able to get people in the house. And again, that's because it was created back when we were coming out of the Great Depression, and to be able to get to re-stimulate the economy in a sense, get people owning homes again. So if it were me, if I was able to buy, if I was buying a house right now, and I lived in an area that had 2 to 4 unit, I would 1,000% utilize an FHA loan on that property, use it as my primary, rent the other three units out, and now you have yourself, residual income in the form of rent. Someone else is actually paying your mortgage for you, because I'm pretty sure your rent's going to be more than what your mortgage payment is on those three units. You know what I'm saying? Um, and you're basically just living for free at this point. Dope hack, super dope hack. Another benefit of FHA loans is that they have what's called, I can't remember the damn name of it. It's a 20, I think it's 203K, which is a rehab loan. So if you wanted to go, you borrow the builder, and there's this house that needs work, that needs a lot of renovations, you can actually use a rehab loan from FHA to buy that property and fix it up. They'll give you the finances to be able to do all of that. Now the caveat is that you got to keep you. They're going to keep tabs on you, because the funds are only allocated based off of, you have to have someone that does construction, um, obviously, and then with that, the amount of money that's required has to be reported to the FHA as well, and then they disperse the funds as you're completing the project. It's really dope to be able to have them finance your renovation, because again, the whole point of this, with them being a government entity, is to try to bring back or revitalize neighborhoods and things of that sort, um, and just kind of beautify the whole thing. All right. So we talked about the aspect of FHA loans being more convenient, more lenient when it comes to the credit guidelines. Just kind of recapping that whole thing on this here. Low down payment, 3.5%. You do get a lower interest rate than you do on a conventional mortgage. Um, the mortgage insurance somewhat negates it, so it's really kind of the same when it's all said and done. But on paper, you have a lower interest rate. The credit guidelines are a lot more lenient than they are on conventional. On conventional loans, you have to have at least a 620 credit score, and quite frankly, even if you have a 620 credit score, because of the way that the pricing works on conventional loans, the cost will probably be so astronomical that it wouldn't make much sense. So unless you had like a 640 to a 680, um, that's really where you probably will stand in that regard. You have the mortgage insurance rate, which is cheaper than on conventional loans. So even on conventional loans, if you have less than 20% worth of equity in the home, you're going to have mortgage insurance there too. Some companies offer what's called lender paid mortgage insurance, where instead of you making that payment, obviously then the lender pays it. There's some pros and cons obviously to that. You take a little bit of a higher interest rate, but you avoid having to have that extra payment, extra cash in your payment monthly. Like we mentioned, a lot of condos, because I'm pretty sure there's a lot more condos than what we saw on that list from earlier. And a lot of condos aren't approved when it comes to FHA loan. You can't cancel the PMI unless you refinance into a conventional mortgage. And just like conventional mortgages, the loan limits are based off of the region or the state that you live in. So FHA and conventional, they all have their guidelines when it comes to the amount of what your loan amount is. For conventional, I think it's up to like 700,000 now before it gets to being what's called a jumbo loan. We'll talk about all that shit at another time as well. But depending on what state and what county you live in determines the amount of the loan limit. So, like if you were to live in like Beverly Hills, right, LA County or something like that, then the loan limit there is going to be a lot higher because of obviously the prices of those houses than it will be if you were to live in like Phoenix, Arizona, right? Just because of the type of property, the cost of the property in those areas. So those are some of the ins and outs when it comes to the actual loan limits, the credit score, the mortgage insurance, and the fact that again that it has to be owner occupied. You have to be living in the house in order to qualify for an FHA loan. And so the process, right? The process of the FHA loan is the exact same as the process for any other type of loan. Basically, you're going to get your pre-approval. Okay, you get your pre-approval. From your pre-approval, you're going to go buy your house. Okay, you're going to go buy your house. Once you buy your house, once you look for your house, you're going to go look for your house. Hey, found this house, love it, perfect. You put in your offer. Okay, your offer is either accepted or not. For simplicity, the offer is accepted by the seller. Then you got your application, which is actually done before. That's part of the pre-approval process. Quite honestly, that's how they know you're approved. Um, then you provide them with all your actual documentation, your pay stub, W-2s, bank statements. You get your appraisal, you get your inspection, yada 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 during the loan processing, and then that's also done during underwriting. So they're verifying the tax, the title, um, letting you know how much the insurance is going to be on the home, so on and so forth. And then, well, as long as everything goes smoothly, you close and you get your keys, and now you're in your home. Nice thing about mortgages is that you know how apartment complexes tend to offer those like move-in specials. You get a month free type deal. Um, Generally, when you buy your house, your first mortgage payment isn't due until the month after you close. So let's say you close in December, your first payment won't be due until February, specifically because your mortgage is paid in arrears. All right. So when you make your mortgage payment in February, you're paying the interest that you're paying on that loan is what's accrued over the month of January. Right. And then also for the simple fact that they have to establish the servicing for that loan. So when you close, let's say you close with Chase, right? And let's say Chase doesn't service loans, which means they don't retain the loan. They'll sell that loan off to somebody else, and you make your payment to whoever that may be, whether it be like Nation, was it called Nation Star or Mr. Cooper, um, Rocket, um, Wells Fargo, whomever it may be, they will retain the servicing rights. So they collect the payment, and then whoever did the loan is done. Right. So just kind of recapping everything that we just talked about, because I know I gave a lot of information and not a lot of time. Because quite frankly, I want to give y'all information so I can go on about your day. You know what I'm saying? FHA, 3.5% down, minimum down payment. Okay. Um, Minimum credit score 580, 500 with some compensating factors and depending on the lender itself. So, um, so just for the sake of simplicity, let's just say 580 minimum credit score. Your debt to income ratio has to be at a maximum 43%. So all of the debts in your credit report, like I mentioned earlier, the debts that's in your credit report, the monthly payment, not the balance, not the balance to limit ratio, the monthly payment that reports in your credit bureau, not including utilities, not including medical, versus what your gross monthly income is, has to be less than 43%. Now, there is a caveat because student loans, if you have student loan, excuse me, if you have student loans on your credit report, FHA calculates student loans at 1% of the loan balance. So if you have $100,000 in student loans, and let's say they're all deferred, right? So there's no actual payment on those student loans at this point. It don't matter. FHA is going to hit you for 1% of those student loans as a payment. So that's going to be $1,000 that is added to your debt ratio, even if that loan is in deferment, right? Because at some point that loan's going to come out of deferment. So that's one caveat. Student loans are calculated at that 1%. So keep that in mind. So lower down payment, 3.5%, lower credit score, 580, higher debt to income ratio requirement at 43%, the ability to use to purchase a multi-unit property as long as it is your primary residence, because FHA loans, it has to be your primary. The ability to use FHA 3.5% to buy multi-unit properties, and for that multi-unit property to help when it comes to the qualifying aspect for the rent that comes from those units. Um, and then generally you have you do have a higher reserve requirement or asset requirement. But again, those are just some of the compensating factors for having a lower credit score. Right. Um, if y'all have any questions, I don't know, any uncertainty on anything, just hit me up. Let me know. I want to make sure we get an answer for you. I want to give y'all the game so that when y'all go into these situations, y'all ain't surprised by when you get the documentation on what shit looks like, and you know exactly what to expect. All right. So hit me in the chat again if you want one of these shirts. They're only $10. DM me. And then again, if you're looking at the fly export stuff, I'll pull that up back up. Bam. There's the code. Check my guy out. Pretty dope merch over there. And then we'll see you on the next one. Hope y'all have a dope week. Have an amazing week. Run up the cash. Get paid. Let's get this money in a minute.